Hi guys, I hope everybody's well today. Today's video I'm going to be speaking about basically technical analysis tools and the rules behind them. So everybody knows what a Fibonacci tool is. Everybody knows what a trend line is. Everybody knows what consolidation means. People understand these and people understand what a moving average is, but unfortunately they just don't know the rules behind each of these tools. So I want to go over these rules with you so you can better understand how to use them within your trading. So most people believe that they require 3 touches minimum to really kind of produce anything. So they need 3 touches to confirm that we're in a range, 3 touches to confirm that it's a trend line, 3 touches to confirm a pattern, all those kind of things where they require 3 touches. And basically what they're anticipating is once they've confirmed the 3 touches, then they're executing on the 4th. Now, the problem with that is that I've back tested this strategy time and time again. And in fact, what I've realized is we actually only need 2 touches to confirm what we're looking at is indeed what we think it is. For example, we need 2 touches to be able to apply a trend line, 2 touches both top and bottom to create a range, 2 touches to confirm a neckline on a head and shoulders or an inverse head and shoulders pattern, 2 touches on a bear flag to then execute on the 3rd. So execution for us is always on the 3rd touch. Now, the reason why the 3rd touch is just so important is simply because it's an 80% probability that price is going to respect that level once again. Now, the problem is once we get to the 4th touch, the 4th touch is when it starts becoming almost like a 50-50. It's a 50-50 whether that line's going to be respected again, whether that pattern's going to be respected, that range box, etc. So I just want to draw out some patterns and some trend lines and go over also the Fibonacci percentages, what exactly they mean, why price is going to go to a certain percentage, because with our Fib tool there's a lot of confusion. Some people use different percentages. For example, 62% instead of 61.8. Some people use 71%, which is the midpoint between 618 and 786. Those are things that I don't use myself. The reason why I don't use them is simply because they're not Fibonacci levels. Okay, guys, so maybe it's best if, for those who don't understand Fibonacci percentages exactly themselves, maybe it's best if you do some sort of history on those, because Fibonacci numbers have been around for a few hundred years now. They were invented by a guy actually called Leonardo Fibonacci, and he basically founded this ratio where the numbers itself is infinite. They go on forever and ever and ever. This particular sequence is found within human DNA, nature, things such as shells and etc. So it's a really, really interesting topic, and I highly suggest you guys look into it. But basically the key here is that we only want to use Fibonacci percentages and ratios that the big institutional banks, hedge funds, etc. are using. We don't want to be kind of messing around with those levels. And we can confirm that the 38.2, the 618 and the 786 are definitely Fib levels. We also throw in the 50% because the 50% makes sense, because normally what you get is you get a big move, and most of the time you can also get sort of 50% of that move too. So it's very important that we understand Fib levels, exactly what they mean, why they do what they do. So first of all, I'm just going to go through how to trade a range. So it's very important that we learn how to trade a range, because the market is in fact ranging 70% of the time. So let's just go through this together. So if we get an up move like this, the first thing that I tell everybody that I work with is the moment price stops, so say here, we don't care why price has stopped. We're not interested. It may have stopped because it hit, I don't know, some previous resistance or a certain level, etc. But we're not too fussed about why it stopped. All we want to know is when it has stopped, can we put a fib on it? Okay? So that's what we would do. That's the first thing that you do. Anytime price stops, we want to throw a fib straight on it. Now, the reason why we want to throw a fib on it is because now we're looking for price to come down and respect one of our Fibonacci percentages. One of these levels it has to respect, okay? Now, say just for an example, with this particular trade, price came down like this. Okay, and it stopped here. All right. Now, therefore, because it stopped at one of these fibs, generally speaking, we would target 0% first, and then we target a new higher high. All right, like that. And then price comes down again, it stops, and then keeps going, etc., etc. Now, for example, if this price came back up to here to create almost this double top, and then came back down like this and created a double bottom almost, we now have our 2 points, 1 and 2, 1 and 2. Now, we don't need to wait for a third point. All we simply now need to do is box it off. Okay, that's the first thing that we would do. We'd box it off. So we create almost like this sort of support and this resistance. So we can now confirm that we've got touch 1, this side. So we've got one both sides. What I'm going to do is I'm just going to make this bold. I'm going to make it a little bit bigger. Okay, so just so you guys can see it nice and clearly. So one touch at the top, one touch at the bottom. And then we've got 2 touches at the top. And obviously 2 touches at the bottom, okay? So therefore we've got our 2 points now. So now all we need is 2 points, both top and both bottom, to confirm that this is what we think it is. It's a range, okay? We're now in a range. We're in this range until we break out. Now, like I said to you before, the market is ranging 70% of the time. 70% of the time we are in some consolidation, and ranges are best used on 1 hour, 4 hour, daily, weekly, and basically we can trade within a range continuously until it breaks out. But we know that the third touch is the highest probability. The third touch is an 80% probability of continuation. So it almost has an 80% chance of respect on the level once again. Okay, so we know that when price comes up to here, we have an 80% chance that it's going to reject. All right, so when price comes up for the third touch, there's an 80% chance that we're going to come back down again. So therefore, this would make this a really, really good selling point. Yeah, so simply what we would do is, say for example, this is a daily range. We would scale down on the 4 hour and the hour to almost, we know that this is a highlighted region. You've already highlighted it and it's an area of interest. So as price starts to come up, that's where we would have to scale down on the 4 hour and the hourly to see what kind of candlesticks are forming to suggest to us that this price is being respected. Now, if we begin to see it being respected, that would then place a sell. So we'd place a sell here. And obviously what we'd simply do is put our stops just above the previous 2 points. Okay? And therefore, first of all, we'd be targeting the bottom like that. So that would give us a nice risk to reward. It's a very, generally speaking, it's quite a really good, healthy risk to reward when we're trading ranges, as long as we get those confirmation that points that are being respected. And that would be our third touch. And then what would happen is that we'd highlight this region here, because we're anticipating another third touch once this rejects. We'd come down like this. And again, we'd look for the same thing. If this was a daily range, we'd go down on the 4 hour, 1 hour, so we can see a better, clearer picture on what's happening when price does approach the highlighted area of interest. And then we would produce another third touch. So again, 80% probability. And the same again. We'd go long here. All right, we'd go long. And we'd just simply put our stops again, ensuring that we're clearing these 2 points. All right, giving it enough space to breathe. And again, we target up here. All right. Now, that's our 2 trades, our 2 high probable trades. Now, when price then makes its way back up towards this zone, we now know that we're approaching the 4th touch. Now, we know that the 4th touch is a 50-50 that it's going to either break or obviously respect. All right, so this is the 4th touch. Because we know that information and we understand the rules of the market with regards to ranges, we are anticipating that price is probably going to break like this. So therefore, this is one way we can trade the range. We can simply buy and sell it when it keeps hitting these points until it eventually breaks out. The other way we can buy or sell a range and we can trade a range is to simply buy at the moment it breaks out. Okay, but this is not something that I want to teach you guys. I only want to teach you how to trade on probabilities and almost close enough guarantees. So therefore, we wouldn't trade at the moment it broke out. We would wait for the retest, and then we'd go long, all right? Now, obviously, when price stops here, we can also do something else, which adds another layer of confirmation, is we can fib it. And generally, retests also line up with the 38.2 fib. So the 38.2 fib works really well with retests. So this would be another layer of confirmation. So again, if this was a daily range, and price had broken out, we would have to go down on the 4-hour, 1-hour to see if price was respecting this to then consider a long. And then as an extra layer of confidence, we can use our fib levels to also see if price lines up with the range resistance, and hopefully see if also this level lines up with one of our fibs. All right, so that's the 3 ways that we can trade a range, either within it when it breaks out, which is not really something that we do, and then we can also trade it upon the retest. And obviously if that retest also lines up with something else, then happy days. All right, so that's the 2 ways. Now, something that I've asked a lot of people when I've done my mentoring sessions is, say for example, this was our range and this was our price action, and we had, say from previous price action to the left, we had a resistance here from one point and a resistance here. I would say to people, okay, when this breaks out, where would be your first target? Now, everybody says, my first target would obviously be the next resistance. Yeah, but that's not true. Because something that we have to understand is that market patterns always will trump and dominate market structure. Okay, so therefore, we have to know how market patterns and ranges, etc. work and the rules of those patterns to know our targets. All right, so what we would simply do is once this breaks out, we would just duplicate this range. Okay, so that would be our target. And this is why a lot of people get stopped out, is because they're targeting the next part of market structure. What happens is that when price gets to here, they end up holding the trade and thinking, well, I'm going to go here, and then price never really gets here, and then it reverses, and it drops, and then they end up losing half their profit, and then they end up just closing it out. All right, so it's very important that we understand how ranges work. They work like this both ways. So therefore, if they broke out to the downside, our first target is always duplication. Okay, it's very much the same both ways. So we would wait for the break, like this. We would wait for the retest to confirm. We'd scale down to make sure it is respecting the retest, and then obviously we would target like this. So I hope you guys understand how to trade a range. Now, ranges can be found everywhere. They can also be called consolidation, where price is resting. I've shown you on EURUSD how accurate ranges are on the weekly time frame, how we can simply duplicate a 2-year range to try and get targets. I'm also going to show you another pattern that I use, which is also very accurate. So, price is going up like this. Okay, nice big bullish move up. Again, we know that when price stops, we can put a fib on it. So you have to wait for price to signal to us that it's stopped and it's slowed down. It's found some sort of, resting phase. And therefore, because it has stopped, again, like I said, we put a fib on it. And now we're anticipating for price to come down to one of our levels to retrace, to then go, say, for example, to here, to then go long, like that, yeah? Simple as that. It's as simple as that. This is how we use fibs. And I'm going to go a little bit more into details about fibs within this video. Now, let's say, for example, price did similar to what it did with the range. Came down like this, hit our 38.2, because this is a nice high momentum trade. And then we came up like this. Yeah. And then what happened is then price came down like this. All right. Now, for me personally, because of my experience within the market, and maybe you guys are seeing this as well, I would start thinking to myself, this is beginning to look a lot like a head and shoulders pattern. Now, something people need to understand with head and shoulders patterns is a head and shoulders pattern is only valid, in my opinion, if it is found at the top of a large up move. The reason being is because a head and shoulders pattern is a very strong reversal sign, and it's the same with an inverse head and shoulders. Inverse head and shoulders, which is the pattern obviously back to front, is found at the bottom of a large down move, because again, it's a very strong sign of a reversal. Now, generally speaking, you won't see these kind of patterns on a 15-minute time frame. Even a 1 hour is a little bit messy. You'll normally find them on daily 4 hour. But even if we do find them on daily 4 hour, they can be traded on the 1 hour and the 15-minute, because we're always scaling down on our trades to try and find the best entries and to try and confirm candlestick formation rejections. But the actual pattern itself, most of the time, will be found on the daily, the 4 hour. So when I start to look at this and I start thinking to myself, do you know what? This is very much starting to look like a head and shoulders pattern. The first thing I do, back to the theory of the 1 touch and then the 2 touch, is once I have my 2 touches, 1 and 2, I would simply put what I think could be, I'm not so sure just yet, but I'm thinking to myself, do you know what? This is starting to look a little bit like a neckline of the head and shoulders pattern. Okay, so obviously because we've also produced this resistance, I can also put a resistance line in too. Now, with me personally, I would always be looking for equal movements to validate that this is head and shoulders pattern. Some people do stuff like this, where they say that this is head and shoulders pattern, where it goes like this, comes down, goes like this, comes down, and then goes like this, and then comes down like that. Now that for me isn't a head and shoulders pattern. There's many different variations of this, but for me it's always, everything is to do with equal movements, and the most powerful head and shoulders patterns are equal movements. Okay guys, so don't trade it unless it's equal. If you're not sure, message me. But for me, for it to be as powerful as possible, one, it has to be on the higher time frame, because obviously, you know, the higher the time frame, the stronger the pattern. So that's always a great confirmation. And secondly, it has to be equal movement. So therefore, if I'm seeing this and then suddenly prices start to slow down here, I can obviously add this neckline in. So therefore, I'm thinking to myself, neckline, not backline, sorry, neckline. I'm not sure just yet. Is it a neckline? I don't know. And then I'm thinking to myself, is this the left shoulder? I don't know yet. I'm not so sure. Is this the head? Maybe not. Who knows? We don't know until the right shoulder. So this is where we have to start anticipating the right shoulder. This is where we can predict the future, right? Because we've got these two lines in now, and simply what we would do is we would grab an arrow and we would duplicate the left shoulder like this. And now we're thinking to ourselves that price is probably going to come up here like this, all right? So we scale down, we're beginning to see price respecting this level. And then what happens is this price starts to come up like this, slowly, and we're thinking, this is starting to look a lot like a right shoulder. So then what we can do is, because price has stopped, what's the first thing that we do when price has stopped? We add a fib. Now, generally, the right shoulder normally lines up with the fib level too. All right, it normally lines up with around sort of the 50, 61, something like that. Now, every single time I've traded this pattern, what I generally do is price starts coming up like this, coming like this, and then it starts rejecting also, as another layer of confidence, first of all, the left shoulder resistance, which is this, and then it also starts rejecting a fib too. Now, when I scale right down, so say for example, this was a 4-hour head and shoulders pattern, I'd scale down to sort of like the 1 hour, 15 minute, and I've already highlighted that I know that this is an area of interest. I know that before it even gets there, I'm thinking to myself, I need to be on the ball today, because when price comes to this zone, I need to be scaling down and watching to see how price begins to react. Now I've scaled down now. I'm seeing prices starting to create, you know, dojis, spinning tops, you know, high test candles that suggest that this level is being respected once more. And that's when I'm thinking to myself, okay, let's just wait for a couple of taps. Let's wait for one rejection. And then obviously I'm getting into my second rejection and using my first rejection as benchmark for stops. Very similar to how I did the EUR/USD trade, which you'll see further along, the EUR/USD market breakdown. So therefore, what we would wait for on this level is, say for example, this is our highlighted region, zoomed in. We would basically wait for, say for example, this is a 4-hour pattern. We're approaching the highlighted region of interest. We'd scale down, and we would be waiting for a candle to pop up like this, come down, mess around, another couple of candles, messing around, second tap, and then we'd get in on the second tap. So this allows us nice tight stops. So therefore, we'd always get in on the second tap rejection and use the first tap as benchmark for stops. So we just go above the first tap. All right, so that's almost like our zoomed in version. So I'm going to show you guys a little bit more about entry techniques. So therefore, we'd wait for first tap, second tap on the smaller time frames. We've confirmed now we've got a double tap, so therefore it's almost like, yep, this level's been respected. And what we would do is we would go short off the top of this right shoulder, and we basically make sure that our stops are above the left shoulder resistance and above that first tap that we've identified. Now ignore these levels here, these numbers, they're very relevant. This is just to show you an example. Let me just plug this in. So with regards to targets for head and shoulders patterns, okay, people get confused because, yet again, like I was explaining with the ranges, fib extensions for head and shoulders patterns are irrelevant when it comes to these patterns, okay, because the pattern will always trump anything else. Patterns are very strong, so therefore most people would be targeting the -27 or the -618, which I'll go over shortly, Fibonacci percentages and what they mean. So generally speaking, when you take a trade off one of these levels, you would be targeting this level and then this level. All right. Now, targets for head and shoulders patterns, when price begins to come down to the neckline like this, is simple. We simply duplicate from the neck to the head, like this, and this would be our target. Always this, always duplication from head to neck. Now I've back tested these patterns, and this particular strategy is a very strong and powerful strategy. So it's something that we always need to use and be very aware of, because if we can get a target down here, why would we bother doing anything else? All right. Now with fib rules, like I'm going to go over shortly, what we would actually do is we would take off 50% of our trade at 0%. Well, it doesn't necessarily have to be 50%, but we want to take some of our trade off at 0%. Now, the reason why we want to take some of our trade off at 0% is because just in case price comes down, makes a double bottom and then flicks up. All right, so we want to take a little bit of trade off here, a little bit of our profits to reward ourselves for our patience and our accuracy. And therefore, we'd let the rest of the trade run to the duplication of the neck, and that's what we'd do. Now, if you'd missed the right shoulder, all right, and that didn't, that you completely missed it, then simply we would wait for a break of the neckline, like so, wait for price to finally stop, and then we wait for the retest, which, like I said to you before, generally always lines up with 382, which is another layer of confluence, and therefore we'd be shorting again. Now, again, fib extension targets do not matter, but normally you'll find when you do break the neckline and retest, the -618 normally lines up with the duplication as well. So that's like almost another little confluence. And obviously, again, now that we've got 2 points, we can draw a trend line, and then we might get another pop up. Yeah, so we might get something like that where we pop up again, retest the trend line, and that's kind of how it goes. So that would be how you would trade a head and shoulders pattern. You can either come off the right shoulder by just having the left shoulder. You can anticipate a duplication, do a fib from here to here when price shows you that it's respected, draw the neckline, anticipate a duplication, draw the fib, come up. Most of the time this is a fib level 2 off the left shoulder. And then that would be your first execution. Your second execution would be a break of the neckline. And because we don't trade breaks, we trade retests, we would have to wait for it to retest. Now, the retest doesn't necessarily have to line up with the fib level, but it is another nice little confirmation that it does. Now, if this is a 4-hour pattern, this is a 4-hour and shoulders, sometimes what you might find is that the 4-hour candle closes like this, and it just keeps going and going and going, and you feel like you've missed out. Now, when it does break, we already know that, like I said, this is a highlighted region. The moment it breaks, we need to scale down on the 1 hour, the 15-minute, and look for the retest. Because sometimes what happens is that you do actually get a retest, but you just didn't see it because you're on the higher time frame. So therefore, if you scale down the moment it breaks, 9 times out of 10, you'll actually see a retest of this exact neckline on sort of like a 1 hour, 15-minute. So make sure that the moment price does what you think it's going to do, quickly scale down and see how price is reacting, because otherwise you're going to miss most of the move. And what you're going to see is a 4-hour close that closes like this. You're going to think that you're going to get a 4-hour retest, but in fact, it will just go without you. And that's what it will look like. But then suddenly when you scale down, you've seen actually the 1 hour wicked up, rejected this, and then fell over again. So that's how we trade a head and shoulders pattern. And again, it's very the same with an inverse. We get a big move down like this. Okay, price stops. What do we do when price stops? We put a fib on it. Price comes up like this. Yeah, and then price goes to target here. And then obviously price comes back again. And the moment it does that and it rejects again this level here, the first thing that we can do Let's put a horizontal line on it to mark almost like a resistance. Now suddenly again, this is beginning to look like an inverse head and shoulders. So what would we do? We would duplicate the left shoulder like this. Put it here. Because price has stopped here and here, we can now fib it. And like I said, 9 times out of 10, when price comes down for the duplication, it will also touch a fib level. And it will go like this. Now, with regards to stop losses, like I said, you'd have to scale down and see that this level has been rejected. Wait for the first tap, second tap. Use the first tap as benchmark for stops. But another way you can make sure that a head and shoulders is invalidated is making sure that your stops, if you want to be sure, your stops are below the 78.6 on this version or above the 78.6 on the bullish one. So on obviously the actual head and shoulders that we just went through. So you'd know that if basically price came down and closed below the 78.6 is invalidation, because basically the 78.6 is the last point of invalidation. Okay, so therefore this would void our pattern. It would mean that this pattern isn't happening, and actually if this pattern isn't happening, then we're probably going to actually come down and create a new lower low like this. Alright, so this is where when we start seeing this left shoulder head, we have to be on the ball. We have to instantly put this on. And then obviously we have to instantly put this on. So we box this off, box this off. We're anticipating a duplication move, the left shoulder to create the right shoulder. Therefore, we would be entering a long position of a rejection here. So again, if this is a 4-hour pattern or a daily pattern, we'd have to go down to the next time frame and make sure that we are indeed getting the rejection. And the target is duplication. So again, we're going for duplication every time, not fib targets. Any other time, we're going for these fib targets. All right, so we come up like this. Our long position would be off here, of a rejection of here. Our stops can either be below the left shoulder or a double tap on the small time frames, or if you want to be safe, put it below the 78.6 because we know that's the last point before invalidation. And with fibs, you target the minus 27 thing, but we don't do that on this example. We target the duplication. All right, so we would take off 50% of our position here just in case it respects this resistance once more, and then we'd let the rest of it run to duplication. Now, somebody said to me, how do you know when to put your stops at break even? Now, with any trade that we place, the first thing that we have to do before we place the trade is we have to define what our stop loss is going to be for this particular trade. Now, this is something that I cover in risk management, but if we don't know what our stop loss is, then how are we supposed to know whether it's a good risk to reward? If we're just guessing and we're just placing a random stop, 9 times out of 10, there's no real reason behind that. So therefore, we're just randomly placing a stop loss of no particular amount. There's no reasonings, and therefore most of the time we get stopped out if we do that. But we have to have our trade pre-planned before we actually place it. So the first step, the most important step, is to first define what your stop loss is going to be. So on this particular trade, we would say to ourselves, okay, 30 pips would bring us just below the 78.6. That's a nice healthy stop. And then the next question you need to ask yourself is, what is my target? So unless you don't understand these market patterns, you're never going to know where you're going to target. So therefore, people just randomly close trades when in fact you could have held it for a lot longer just because they didn't understand the rules of the market. So therefore, this particular pattern, like I've said to you, is a duplication from head to neck. All right, so if that's the case, we know that our target is here. No matter what happens, that's what we're doing. Unless we get stopped out, that's what's happening. That's what we're aiming to go for. So if we know that our target, say for example, once we've defined our stop is 30 pips, then we need to ask ourselves, okay, is our target at least double? All right, so we need to say, is our target at least double the 30 pips? Because if it isn't double, then it's not worth the trade. And if we can't define a stop loss, we should not be placing the trade. If we can't define a target, then we shouldn't be placing the trade either, because if we can't get at least double our stop, then what is the point in taking the trade? Because therefore we're risking £1 for £1, when really we're in here to make money, and we only want to risk £1 to make £2. All right, so now that we've confirmed that this is a healthy stop and this is a great target, we need to decide when we're going to break even our trades. Now, we'd only break even our trades once we've figured out what our target is. Now, let's say, for example, this target of ours is 100 pips. Let's say this is a 100 pip move. we would only break even our trade, all right, once we've defined what our target is, and then we break even our trade at 50% of that target. So therefore, if it's a 100 pip target that we're gaining and we're shooting for, then we can have a 50 pip loss at most, because that would be a 1 to 2. Ideally less though, because we want a better than 1 to 2. And then once we've defined our target, which is 100 pips, we know that we shouldn't really be break even in our trade until we get at least 50% of that target, which in this case would be 50 pips. So that is your answer to how to define when to put your stops at break even. First of all, define your target, guys. Okay, figure out where you're actually going with this trade and stay in it. Have confidence within what I'm saying. When we know for sure that it's a duplication, then that's what we want to go for. So I'm going to show you loads of examples of head and shoulders patterns, inverse head and shoulders patterns of when they're being used and how accurate they are. I might show you in this video. If not, I'll do a separate video and actually showing you real live examples and how they, always meet targets and how to enter those trades, what to exactly look for. But that's the first pattern that I want to go over. So as I said, it's a lot to do with duplication. So we've gone over ranges, we've gone over inverse head and shoulders, which are strong reversal signs. Inverses are found at the bottom of down moves. And then we've gone over actual head and shoulders patterns, which are found obviously at the top of up moves. We've gone over the fact that once we've produced this move, we can put a fib on it. We come down, we create this point here. And then we create our target, so we hit target. And then we come back down here, so therefore we think this is a neckline. We instantly place the neckline. We find the duplication. We put support or resistance at the left shoulder. And then we know that we're anticipating the right shoulder because we're looking for the best entry of the right shoulder. Again, if you miss this, you would simply wait for it to break out, retest. Once price stops, like I said to you before, if you've also got a retest at 30.2, that's another layer of confidence anyway, which is great. So let me just accurately do this. So we break it like this. Price would stop, so we'd put the fib in it, a bit like this. We'd come down, we'd test here. And then obviously we'd continue to our duplication target up here. And obviously another layer of confidence now would be because we've got our two touches, we can apply a trend line. Yeah? So you can kind of see how market structure now plays out. So that's inverse head and shoulders and head and shoulders. And we've also gone over ranges. The fact that even with a trend line, we only need two touches. Now, I'm going to show you an example of fib levels and how a fib works. So these are my Fibonacci levels. Okay, so this is a bullish fib. So we're going from the bottom to the top, bottom to the top. Now a bearish fib is going from the top to the bottom. Okay, top to the bottom. Now I know that a lot of you guys don't use the 38.2. I know a lot of you guys, like I said before, I've got other percentages added to this, such as the 71 or 62. You've rounded it off or whatever, but we only want to use targets that actually are real Fibonacci levels, because as far as we're concerned, like unless other people are using them, it's just not of interest to us. Okay, so this is why we're always aiming to target and use what other people are using. It's really as simple as that. So therefore, if this is an up move, what we would get is we'd get a move like this. So therefore, price would stop, we put our fib on it. And if we get a down move, we get this, and price would stop and we get a down move. So what's happening is that when we get these big moves, they don't necessarily have to be big, but it's only when price is stopped. What we are anticipating on a bullish fib is for price to come down to one of these levels. Either the 382, the 50, the 618, or the 78.6. Alright? And again, with this, a bullish one, we're looking for price to come up to the 382, the 50, the 618, or the 786. They're one of these levels. One of these. Now, a lot of people say to me, well, which one do you know it's going to go to? And this is where I'm going to explain it. So therefore, when it does go to one of these levels, we are either going to get a bounce from here, a bounce from here, a bounce from the 618, or the 78.6. Now, we need to define which one it's likely more to go to. Now, each trade is different. Every single trade is individual. There is no one rule fits everything. Okay, so it's about us having to weigh up the probabilities every single time we're looking at a trade. Every single time. So again, same with this. It's going to go to one of these levels, one of them. Now, a lot of people just say, yeah, it's going to go to the 61.8. That's just where it's going to go. But that isn't true. A lot of people have also said to me, do you even use the 38.2? Yeah, I use it all the time. 38.2 is a great Fibonacci tool, especially for high momentum trades. It's good for bear flags, bull flags, all that kind of stuff. So I'm going to go through that next after this. So how do we know which fib price is going to go to? And this is where I'm going to draw this out for you guys so you understand it. Alright, so this is our up move. I'm going to just move the page a little bit further up so we've got a little bit more white space. So, price moves up like this. Yep, we put a fib on it. What do we do the moment price starts? We put a fib on it. Just like that. Now, I'm just going to draw out something to the left here, so just bear with me because this is just me rough drawing freehand. This is previous price action, okay? This is previous price action. So this is what you would see. Just ignore the fact that it's, you know, whether it's lower lows and lower highs and all that kind of stuff. Okay, so this is previous price action. Now, with previous price action, we all know that we can use previous price action to apply support and resistance. So let's just mark all these off. So we've got a nice double top there from previous price action. And then we've got another nice level here. And then we've got like a level here, like this. This isn't a pattern, so therefore what we're doing right now is we're creating higher highs and higher lows here. So therefore we're anticipating, because price has shown that it's stopped, we're anticipating for price to come down to one of our fib levels. We don't know which one yet. Okay, we don't know which one. So what we have to do is we have to get a pen and paper out and we have to say to ourselves, right, in this current scenario, where is price more likely to go? Which fib is more likely to go? So let's go through it together. So we've got the 38.2 price to go to. What confidence have we got around there? We've got the 38.2, which in itself is one confidence, one reason. And there's another confidence there because we've got previous support and resistance as well. So that's cool. So that's one. That's the reasons why we picked that one. Now the 50% on this occasion has only real one confidence. It's just one confidence. And that's just the fact that it's just really got the fib. It's just a fib, that's all it is. There's no other real confidences around it. There's no structure, nothing. And in this occasion, again, we're very similar to the 38.2. We've got the 61.8, which in itself is one confidence. And then we've got, obviously, previous support and resistance, market structure from the left. And then the 78.6, have we got any reasons for price to come there? No, we haven't. So we've got 78.6, which again is just one confluence. No real reason for it to go there. So that's when we have to think. So out of these four, already I know that there's a higher probability of price to retrace to either the 38.2 or the 618. Okay, I know that. Now, because we've got these two touches, there's something else that we can do to help us decide. We can draw a trend line. Now, already by doing that, we've suddenly just cancelled out the 78.6 because the 78.6 is below the trend line. So we know that that one is not going to be an option. Price is not going to go there. So let's delete that. Price is not going to go there. So we've now got three choices. So very much like Who Wants to Be a Millionaire. You have to narrow yourself down to the choices of which one you think is going to happen. Because trading Forex is very much about probabilities. And we have to build as many probabilities as possible. So in this current situation, I would probably say we've got two choices here. Either the 38.2 or the 50. The reason being is because as long as price doesn't spike down like this really quickly, it's very unlikely we're going to hit the 61. We're going to probably slow down. So therefore, I'm thinking on this occasion, price is probably going to come around here. It's probably not going to come to the 618. Now, because I know that 50 isn't really an option, because there's no real confidence around there, I'm beginning to think, do you know what? Price is probably going to come to the 38.2. Now, there's other things we can add into this, such as the 50 moving average, which is the only moving average that I use. Now, if the moving average is doing something like this, yeah, as price begins to approach these levels, like this, the moving average will get closer and closer. Now I'm beginning to see that price is very much likely going to go to the 38.2 on this occasion. Now this is how we can use probabilities. We've got the 50 moving average, which has gone through the 61.8. So we know that 61.8 is just not an option anymore. Okay, 50 is unlikely. It's very unlikely. But the 38.2, we've got one confidence, which anyway is just the fib level, previous support and resistance, and we've got the trend line, and we've got the moving average. So that's 4 confidences to suggest that price is probably going to stop here and not the any other fib levels. All right, so let's say this was our example. Done. Price stops at 30.2. Price bounces, creates a new higher high. We can drag our trend line like this. So what do we do when price stops? We can add a fib. So let's do that. Let's add a fib. Let's make sure that our fib levels are back on. Cool. So again, in this scenario, price stops. What fib think it's going to go to? Now we know it's not going to go to the 78.6 because that's just that's below the trend line. It's you know, at this point our moving average would be sort of floating through like this. So we know it's not going to go to 7.6. It's probably, again, not going to go to the 6.8 unless it sharply drops, which is a possibility. So therefore, we'd have to watch how quick price comes down. In some occasions, you get it where a news report comes out and then this just sharply drops down, taps to 6.8 and then bounces up. But if in normal trading conditions, price doesn't move that quick, so therefore it trickles down. So again, it's a very similar situation where we know that if we're guessing how fast price is going to move, it's probably going to do something like this, where it goes like that, and it trickles down. Yeah, so therefore we know that it's very unlikely on this occasion that price is going to hit any of these fibs, any of these. So this is why, you know, each Fibonacci tool is equally just as important. This is how we can almost anticipate which fib it's going to go to, because we have to weigh them up. We have to look around these fib levels and think to ourselves, okay, what's got the highest probability of price going to that fib? Now we can just keep doing this over and over again. Yeah, price comes down, say, I don't know, let's just say the 50 this time, bounces, we buy it, target a new higher high, price stops. So it goes like that, price stops. What do? The first thing that we do, we put a fib on it. Now, on this occasion, unless price moves really slow, it goes like this, then we might go to the 38.2. But actually, what I think on this occasion is the price is more likely going to go to the 61.8. You know, and then look, this is another thing we can do. We can begin to basically put the support and resistance here, which is now support. So actually, maybe price has got a higher chance of going to the 50% because this has actually got now a support and we've got the 50%. So maybe we might not even reach these ones. And then say we had our moving average that was going like this, and price was getting closer. As price was getting closer, the moving average was getting closer to the price. And we go down like this and we bounce. So we can keep doing this over and over again. Obviously, we have to be aware that the more bounces we get from the trend line, if we start getting into full touches, we have to be a lot more aware and make sure we've got more confidences. Because otherwise, you know, the fourth touch has got a 50-50. So this would be where we start getting a bit dangerous. Now, we can keep doing this until price breaks this trend line. Just keep doing it until price breaks. Now, let me just do this a bit more accurate. So say price comes down and it breaks. Price stops there. What's the first thing that we can do when price stops? We can put a fib on it. Now again, we're looking for a retest, right? We're looking for a retest to go short. So we know that price is probably not going to retest the 618. We know it's definitely not going to retest the 68.6 because they're both above the trend line. Now, what you'll normally get with something like this, as another layer of confluence, is you'll get where the moving average was going up like this to support price on the way up, and then it was going up like this, it broke through the MA, and now the moving average has flipped over like this. So we can actually use the MA as well, the moving average, the 50 moving average, as a dynamic almost resistance. So we're looking for a retest. So price stops, we put a fib on it. Price retrace, we know we're going to get a retest. Where do we think we're going to get the retest? Well, we're going to get it around the fib level which has the most confidences. In this current scenario, the 38.2 lines up very well with the retest. It also lines up with the moving average. So therefore, in this current situation, we'd look for a rejection around this area. So again, if this was a 4-hour time frame, we'd have to scale down to the 1 hour and look to see if price is wicking and rejecting this area. So therefore, we'd place our shorts. And our shorts would be from here, 0%, take some profit off, target 1, target 2. So let's say now price came to here. We'd wait for price to stop. And then at this point, the moving average will be sort of, rolling down like this. We'd wait for price to stop. Price does stop. We put a fib on it. Now, in this scenario, this previous left structure lines up lovely with the 78.6. Beautifully. But also, we have to bear in mind that we've actually also got a most recent support and resistance, which is here. All right, so we've got two areas here which suggest that price might now retrace either to the 38.2 or as high as the 78.6. We've got no real confidence around the 618. But what have we got here that shows to us that it's probably not going to go to the 78.6? Well, we have our moving average, which is below the 78.6. Yeah, you see that? So therefore, it's unlikely price is going to break above this moving average. Now it's broken below it. So therefore, we're now using the moving average as a form of resistance. So therefore, as price starts to approach the 38.2, the MA starts getting closer and closer. It taps the MA, it taps the 38.2, and then price rolls over to create a new lower low. Yeah, and then we can just basically keep doing this. We've got our 2 points. We can join them with a trend line like this. Price stops. What's the first thing that we can do? We can put a fib on it. And now we're anticipating price to come up to one of these. We know it's not going to be the 78.6, it's above the trend line. So it's going to be one of these, depending on how quick price moves. Have we got any other structure to help us out with which fib it's going to be? Yeah, we've got this bit here, look. The price lines up nice with the 50s, therefore we're anticipating the 50. Price comes up to the 50. Are we right? I don't know. Let's scale down, see how it's reacting to the 50. Scale down from the 4 hour to the 1. We're starting to see lots of rejections from the 50. Great. Wait for the first tap. Get the second tap. Use the first tap as benchmarks for stops. As long as we make sure that also our stop losses are preferably above the MA and above the most recent, the next Fibonacci. And we place a short. And we just basically keep doing this until we get to the fourth touch, and then our limits run out. So therefore, what happens is then price stops. We put a fib on it. And then what happens is actually it breaks. It breaks the trend line, and then it breaks also through the moving average. It breaks through it, and we're thinking, uh-oh, this is now beginning to look bullish. Price stops, put a fib on it. The 38.2 lines up with almost really close to the trend line. The 38.2 and the 50 lines up close to the trend line. So therefore, and it also lines up with the moving average. So therefore, because price has stopped, we're expecting it to come down, retest the moving average, retest the trend line, retest one of these fib levels, and then come up, break this, and come up to maybe here or here. Like this. Price stops. What do we do when price stops? Put a fib in it from here to here. The 50 lines up with previous market structure, and then at this point, the moving average will be back below price. It would have flicked over like this. Price comes down, tests the 50%, the 50 EMA, and previous market structure. We scale down the 1 hour, double check that it's rejecting, comes up, and then we keep doing this. We've got 2 points. We can draw a trend line. Yeah, so that's how we would basically keep trading market structure with fibs, retests, multiple touches of a trend line, and how we can almost anticipate which fib level that price is going to go to, because it could go to any of the 4 levels, but it's going to go to the one that has the highest probability, because the highest probability is where all the orders are. So therefore, it's in market's best interest for market to drive the price towards where the most orders are. If the orders are most set at 38.2, and that's where it will go. Because the orders are placed where most of the confidences are. Because the big boys are seeing these confidences, and that's where they're putting their buy and their sell limits. So that's why we have to almost also find out where all those confidences are. So that's how we would trade this. Now, with regards to Fibonacci rules, when we have our Fibonacci tool, so this is our bullish Fibonacci tool. Now, again, price can come to any of these. When this fib is invalidated, like I've said before, is if this is a 1 hour fib, then we need a 1 hour close below 78.6 to invalidate this fib. Now, sometimes what happens is price starts coming down like this, comes down, comes down, comes down, spikes through the 78.6, but then closes like this. And the reason why it spikes through is because the brokers and the market makers, everybody knows that everybody puts their stops below or above, obviously depending on which way the fib is, the 78.6. So because they know that, sometimes what they do is they come through, they spike you out, and then price goes the way that you thought it would. The way that we can get around that is waiting for our first tap, second tap on the smaller time frame. So therefore we haven't actually got to use the 78.6. You can see that in my Euro USD video, where I wait for that first tap, second tap, and use the first tap as benchmarks for stops. But as a rule of thumb, what most people are taught is they're taught that because the 78.6 is the last point of invalidation, it makes logical sense to put your stop, obviously in this case, below it. Okay, so that's how most people use the 78.6. Now, again, like I said, sometimes you get it where it spikes through and then closes below. Now, if this is a 1 hour fib, if you get a 15-minute close below this, that's absolutely fine because it's not invalidated. Because the 1 hour, by the time the 1 hour is closed, it might just look like a wick and the body still might have closed above. So that's fine. If it's a 4 hour fib and you get a 1 hour close, again, it doesn't matter. It all matters on how the 4 hour closes. If it's a daily fib, it matters about how the daily closes. So we always have to be aware of what time frame we're using the fib on. And we always have to wait for that close guaranteed, on depending on what time frame we're on. If it's a 4 hour, we have to wait for the 4 hour close. And that's how we use it. We use it as the last point of invalidation. And almost we use it as well to prove if we're wrong or whether we're right. So, say for example, we're looking and anticipating a new lower low or a new lower high. Very similar to what I did in the Euro USD video. We would use it as if to say, well, as long as price doesn't break this, this could be our new higher low. Yeah, do you understand that? So it's almost like, let's say, for example, price was like this. Came up, retraced, and therefore we've confirmed that this is our higher low. We think this might be our new higher low, but we can also use the 78.6 to confirm that for us, because as long as price doesn't break below here or here, then this is our new higher low. So we can also use it for that too. So fibs are very powerful if you understand the rules. Like I said, price can go to any one of these fib percentages, but it's about looking at other parts of the price pattern and finding out where it's most likely to go, because that's really what trading is about. It's about using probabilities. It's about using as many almost reasons and guarantees and confidences that we can get to try and suggest where price is going to go. Because if we have a narrow mind and we just always think that price is just going to bounce off the 618, what's going to happen is we're going to miss a lot of opportunities, because you actually find that quite a lot of the time price does indeed bounce off the 382 and the 50, and sometimes doesn't even go as far as the 618. And that's because there was more confidence around that area as opposed to the 618. And sometimes people just aren't aware of that. So we've covered head and shoulders, inverse head and shoulders, ranges and targets for all of these patterns. We've covered where the likeliness is of price to retrace to, which kind of fib percentage it's going to retrace to. And we've covered almost like market structure about how to trade a retest, about how, if we get a fib level that's also on the retest, that's another layer of confidence to confirm the retest. And I just want to go over another pattern that I quite like to use, and that's bear flags and bull flags. Now, generally speaking, bear flags and bull flags can happen on most time frames. They can even happen on 15-minute, 1 hour, 4 hour, daily, etc. And what normally happens is that obviously, like I said to you before, the higher the time frame, the stronger the pattern. So we have to take patterns with a pinch of salt when they're on the small time frames, such as the 15-minute, but they're still valid. So what can happen is that we get this impulsive move like this, Now, bear flags and bull flags generally only work when you've got high momentum trades. So large moves up or large moves down. And what will happen is price will come down like this. All right. Now, the best thing that can happen in this scenario is price will come down like this, price will come up like that. Now again, this pattern is not valid until we have two touches. Now once price comes down like this is beginning to look a little bit like a bull flag. Okay, so we've got one touch, two touch. Now what's the first thing we can do when we've got one touch and two touch? You can apply a trend line or some sort of support resistance to put it in a channel. Now, bull flags and bear flags are not valid unless you can channel them off. Okay, so if price is like this, and it's like very messy and it can't really be channeled off and it's like this, then I wouldn't really say that was a bull flag or the other way around. Okay, it has to be able to put a channel around the top and then around the bottom. So once we've got these two touches, what are we now anticipating? We're anticipating the third touch. Now, when we get the third touch, we need a minimum of two and bottom to confirm that this is what we think it is. When we get the third touch, that's the highest probability. So therefore, we'd sell from here because that would be our highest probability of selling. And then we'd buy from here to then break out like this. Now, normally with a bull flag, another layer of confidence that you can use, which really works really well, is if this point here, your last sort of third touch, lines up with the 38.2. I don't know if it's going to on this scenario, but if it lines up with a fib as well, it's really powerful. I quite like using, I'll show you actually, I'll draw it out quickly. So we've got this 1 point here. One, well, I guess that could be 2, and then 2, 3 to sell from the top, 3 to sell from the bottom, and then if the third lines up with the 38.2 as well, then it's just straight fire, bang, like that. Okay, so I really like this third tap to line up with my 38.2 because I really like using my 38.2 fib on high moving. So like when we've got this huge impulsive leg like this, and then we retrace to the 38.2, if we form it in a bull flag, which I can channel off, and then I've also got one touch, two touch to form what I think is a bull flag, and then I get my third touch from the bottom. This is a really, really great execution point. Now, with regards to targets for bull flags, what we would simply do is duplicate the flagpole like this, and that would be our target. Okay, it'd be like that. So that is a bull flag. It's a continuation pattern. It's a very great continuation pattern. Again, I'm going to show loads of live examples of how, where bear flags and bull flags broke out and took place. I'm going to show loads of examples of inverse head and shoulders, ranges, trendline touches, and how we can use break and retests, and show you other things as well, such as rising and falling wedges, because falling wedge pattern is very much like this. Let me show you. So, for example, you'd get a point like this, all right, and then you'd get a point like this. Hopefully I've drawn this properly. You get your two touches, so therefore you can draw your first trend line because you've got two touches now. And then you've got two touches this side, so you can draw your trend line like this. And then when you form your third touch, this is where obviously you'd look to buy it, and then bang. So that's almost like a falling wedge. So again, it's a similar thing, but I'm going to show you some better live examples of this. But generally speaking, falling wedges are bullish because price is being squeezed to the downside and eventually has no choice but to break out. It's going to break out one way or the other. Now, 9 times out of 10, it will break out to the upside. And again, it's the same with rising wedges. Rising wedges are a pattern which looks like this. Again, price is being squeezed. So you'll get something that goes like this. It goes up, down, You've got your 2 points now, both sides. Third touch to sell. Third touch to buy. Yeah? Or vice versa. I'm going to show you better examples of this. But that's anyway, that's a falling wedge, that's a rising wedge. This is bearish, that's bullish. That's a bull flag. And then we've gone over the other patterns, and we've gone over the fib bulls today as well. So I'm going to actually do something where all of this stuff is also downloadable. So therefore you can print off market patterns, and it will also include all of the rules for each market pattern. And I'm also going to do a downloadable printable where you can download my fib levels and understand which fib level means. For example, the 786 is the last point before invalidation, and how we can use that to also determine lower lows and lower highs. And then I'm also going to do a downloadable sheet for candlestick formations of what candlesticks to use when we start approaching areas of interest and how to use those together. So all of that stuff is also going to be available to you guys. So I hope you've enjoyed the video. For now, with this particular one, we're done. I'm actually going to go a lot further in depth on this particular subject. So just keep sort of working yourself through the videos. It's been really great. Thanks very much. Speak to you guys soon.